Our colleague Sarah Eisen is hosting a panel on the global economic outlook, which is just starting, so let's listen in.
And the global outlook on the economy. Obviously, we have a tremendous lineup here. We have Fazal El-Abrahim. He's the Minister for Economy and Planning in Saudi Arabia. His Excellency, thank you. Larry Fink is the CEO and founder of BlackRock. Christine Lagarde is the president of the ECB. We have Kristalina Georgieva, who is the head of the IMF. And we have the president of Singapore, President Tharman Shanmugaratnam. Thank you all for joining us. You know, this Davos has been very interesting. Larry, there's so much optimism around President Trump and pro-growth policies and the U.S. outlook. I sort of wonder, as an asset manager and a risk manager, like, should we take the other side? Are you worried that everyone's too excited right now? Larry, got me?
It's hard to hear.
Oh, it's hard to hear.
This is why we are putting those things.
Oh, okay. I was just asking you if there's too much optimism around the U.S. outlook right now and whether that was worrisome.
Well, welcome everybody. Thank you, Sarah. Now I could hear you. Is there too much optimism in the U.S.? No. But that being said, there's risk in every economy. I can say much more forcibly, there's too much pessimism in Europe. For somebody who's been pessimistic in Europe for like 10 years, if I had my number one observation this week in Davos, the pessimism, I've never felt, the pessimism to be larger and more profound. And I believe it's probably time to be investing back into Europe, focusing on it. I see all the problems in Europe, but I do believe the pessimism is too large. There's many things it needs to do. It needs a banking union and a capital markets union, which I could talk about later on. But back to the United States. I think all the ingredients for the United States it will be the continuation of its strength, the foundation of its capital markets. Any entrepreneur, any small company, any large company can find capital. And that foundation of capital raising allows much more entrepreneurialism, much more creativity. And so I believe the U.S. has the ability, because of its strength of its capital markets, which is solely really underappreciated, allows it to rebuild itself, change directions, modify faster than any economy in the world. And I do believe the economy obviously changes depending on the political party and the president, but the reality is the economy is larger than any one political party or any one president. Obviously, they could be additive to any economy. And, President Trump's policies, if we're able to unlock private capital and put private capital to work faster, easier, with less regulation, less time for permitting, it'll allow the U.S. to become less dependent on its own fiscal problems. And so those are some of the issues that could be worked out. So, no, there's not too much optimism in the U.S., and there's probably more to be optimistic here in Europe.
President Lagarde, I bet you didn't expect to kick off the panel with a vote of confidence for Europe, because what we've been hearing here a lot is Europe's economy is underperforming, the Trump factor is going to be bad for Europe. How have you digested all of this?
Well, good morning to everyone. But I was going to say to Larry that if ever you look for a pro bono job, come and join us in Europe, because you advocate Europe in a beautiful way. So, given where I am, the fact that I'm in my quiet period before a monetary policy week decision coming up soon, I would just like to underscore what Europe is good at. And if I look at the scorecard at the moment, whether you look at debt to GDP, about 80%, overall deficit for the euro area, about 3%, inflation, latest reading 2.4, and strong confidence that it's going down rather than up. Interest rates, 3%. huge amount of talent, huge amount of savings, and a big wake-up call that is really calling the Europeans to action. So if the European leaders can actually get their act together, respond to this wake-up call and existential threat that can be identified, then I think that there is a huge potential for Europe to respond to the call. So I'm also pretty optimistic. I'm realist about the points that Larry made. We need banking union, we need capital market union, we need to keep the talent at home, we need to keep the savings at home, and maybe it's also time to import a few of the talents that would be disenchanted for one reason or the other from another side of the sea.
Just quickly, why do you call it an existential threat? Why is it existential right now?
Why is it? Well, because as Larry was suggesting, if you talk to the CEOs, if you talk to the corporate world at the moment, those that are making major investment decisions, they are not very upbeat right now. And when you ask them why they are not, they're making reference to the price of energy. Fair enough, but energy costs are going down as the recycle, or the non-fossil energy is going up in Europe in a significant way when you consider that electricity production in the euro area at least is now 70% non-fossil originated. They complain about the excessive red tape and the excessive bureaucracy. That's the wake-up call that we Europeans, those in policy-making places, have to really take to heart and respond fast to. You know, there was this great incentive to go and invest in the United States because of the Inflation Reduction Act and the significant subsidies that were going to be given to those who invested in the US. I think the IRA has essentially been removed and that any subsidies under the IRA will not be paid out. So people are going to have to rethink with the prism of confidence, with the prism of cost, as is often the case, and the prism of opportunities. And there is no question that what is happening outside is a challenge, but it's also a big opportunity for revisiting and deciding whether or not Europe wants to be a key player. But I'm contending that it has the talent, and it has the means, and it has the ambition.
Well, we're going to talk about the IRA, and I know President Tarman has a lot to say about industrial policy, but first, MD Georgieva, if you could just give us a global overview right now, because you guys just put out your big world economic outlook, and yes, while there's a lot of optimism and solid growth in the U.S., it's a little lopsided around the world.
Well, great to be on this panel. We published our projections for 25 and 26 just before the forum, and what they paint is a nice picture with some undertones. Nice picture because we project growth at 3.3% this year, and next, this is a slight upgrade for 2025. But under the hood of this average number, we have very strong performance for the US. We actually upgraded growth projections for the US by 0.5 percentage point from 2.2 to 2.7. And we have sort of not great European performance, and then we have the rest of the world more or less a little bit up, a little bit down. The most important message I have for the audience is to ask the question, why? Why growth in the United States is so strong? Why growth in Europe is somewhat underwhelming? Why the emerging markets are not doing fantastically well? And the answer is primarily in the differences in productivity growth. The US is marching ahead with high productivity because capital markets allocate money to dynamic firms, because technology turns into business investment and then it grows into company fast, and because the US has, relatively speaking, abundant, relatively cheap energy. When we look, and then productivity in the United States, year after year after year is close to a percentage point. You look at the rest of the world, advanced economies dropped in productivity vis-à-vis pre-pandemic times from over 1% productivity growth, and it pushes growth up, to meager 0.2% now. Even more worrisome, in emerging markets, productivity dropped from 2.5% to 0.7%, and in low-income countries from 2 to 0. So my first message is, the world is changing very rapidly. We are experiencing a tremendous technological transformation. Capital has to have long legs and go where it would make the biggest difference. And you look at capital, where did capital go with its long legs? It went to the United States. And if countries want to move forward, they have to be very aggressive in opening up opportunities for entrepreneurship. And yes, Europe has to have deep capital markets. It has to have a unified market that makes it possible to compete. And I want to say, I'm a European, I'm a proud European. As a European, I want to make an observation in terms of culture. The United States has a culture of confidence. Europe has a culture of modesty. When I first went to the United States, I went there. If something is done really fantastically well, my parent would say, not too bad. That was the highest praise. And in the US, you just move your legs and you're fantastic. You blink and you're great. So my advice to my fellow Europeans is more confidence. Believe in yourself, and most importantly, tell others that you do.
Good message. President Harman, you know, everybody's wondering how, you know, the Trump presidency, which is so focused on economics and has so many changes from the prior regime, is going to change the outlook for their respective regions and economies. How are you thinking about it for Southeast Asia, emerging markets, the regions that you follow?
Well, first let me say, and I don't want to be a spoiler here, if you look at all the evidence on what ordinary people think and feel, they're not feeling good in the US, in Europe, everywhere in the world. Confidence is down, optimism is down, trust is down. So our real task is, how do we rebuild the bases for optimism in today's world? We're not going back to the era when the Bretton Woods institutions were formed. We're not going back to an era where Henry Morgenthau, the US Treasury Secretary, said in Bretton Woods, prosperity is indivisible. Just think about that. Prosperity is indivisible, meaning I can't prosper unless you are prospering. No nation, even the largest, will prosper unless the rest of the world is prospering. We're not going back to that era. It's past us. It may have rested on a moment in time when the US had an unassailable lead and had that confidence to say prosperity is indivisible. But what we've got to avoid is going to the other extreme of a real zero-sum world. And there's some tendencies in that direction, but I think we are nowhere near it. We have to avoid moving in a gradual, grinding way towards fragmentation and towards some breaking up of the world into blocks. It's a real risk. So what do we do using all the agency we have? The middle powers, India, ASEAN, Europe, Japan, the international institutions. What do we do in between those two extremes? Between the unattainable ideal of prosperity being indivisible and avoiding at all cost a zero-sum world. There's a lot we can do. There's a lot that we can do. But start from the reality that there are strengths in each of our nations, very well described. The US has a unique set of markets and institutions that drives innovation in a way that no other nation or region does. And as Christine says, Europe has human capital, and I mean it not just in terms of expertise, but in terms of values. It's a font of the values that we admire in today's world. Asia has a desire to keep opening up, to keep breaking barriers. Asia is still striking FTA deals. And you now have the UK joining the CPTPP, and there's several others on the waiting list. So build on these strengths, the desire on the part of most of the world to stay open, to be interdependent, so that we can all grow. So let's build a realistic basis for optimism, but starting from a position where people are despondent. And today's generation of parents has very little faith in their children doing as well as them. Let's build new bases for optimism.
I don't think you'd have any disagreement on this panel, though I wonder if you have spoken yet with President Trump, or your Prime Minister has. Have you shared this view of openness?
Well, no, I'm saying something which comes naturally to a small country. I know of other small countries that think alike, including small European countries. You know, being small helps because your basis for doing well in the world is to be relevant to the rest of the world. You never look inward, and you never get too complacent. You never get too complacent. You're always trying to find a way in which you're complementing someone else's strength, and someone else is able to complement your strength. But I don't think that should be the province of small countries alone. We have no choice but to have that cast of mind. I think it also has to be the way in which the major powers think. And in particular, I mean, if there was one real positive coming out of President Trump's speech yesterday evening here at the forum, it was the way he spoke about China and the US. It suggested a desire for a new understanding and a desire to avoid a continuous unraveling of a relationship that is still profoundly important for the global world economy.
And that has been the panel of our colleague Sarah Eisen in Davos. This is actually the very important panel as it caps the week in Davos. It takes a look at the global economic outlook. And indeed, Sarah, they're very much stressing the fact that this week there's been a lot of focus on US exceptionalism. Let's go back to the conversation to understand how these players actually feel about the outlook here.
Basically an OPEC to lower oil prices. Will you do that?
So before I answer this question, I'm just going to comment on what was discussed. I'll get to your question.
I was going to move on to that as well.
But I'll get to your question. I think the way we look at the world is in two lenses. One is data-driven, to kind of explain to us why we're here, how we got here, where exactly we are. But also another lens that is more future-focused. What is the potential we need to unlock seriously? Mm-hmm. If you look at the first lens, like Christine said, there's tepid growth. But also at the same time, the same people talking about tepid growth are talking about the potential positive promise of technological advancements and including generative AI. This economic stalemate needs to be addressed or disrupted. We can't stay here. Keeping our eye on the second lens, the vacuum is, like we've discussed probably throughout the past few days, is intrepid leadership. We need intrepid leadership that is bold but inclusive, disruptive but constructive, ingrained in the long view, like President Thurman said, but also action-oriented today to kind of get us out of where we are. And you see signs of hope or signs of signals that there are directions or momentum in the direction of more leadership that is required for us to get out of where we're from. Saudi Vision 2030 is an example of that. You talk about complacency, President Thurman. I think every day, day in, day out, complacency in Saudi is punched in the face by Saudi youth. We need to make this transformation count. And every region, every economy has its own issue to deal with, whether it's Europe and deregulation, for example, or innovation. The US and the fiscal outlook. China and this new economic model and whether a shift to consumption drive will happen. The Middle East and stability and the need for more Vision 2030s. I think there are some pressing questions that the globe needs to address too. And one of them is energy security or the energy transition. I don't think we can get or can afford not getting the energy transition story right this time. We need to get it right. Energy supply, energy security is essential for global growth, for global prosperity. The Kingdom's position, OPEC's position is all about long-term market stability to make sure that there's enough supply for the growing demand, and there is growing demand. Whether it's the growing demand we see in the US alone, whether it's the growing demand that's coming from AI, demand will grow, and we need to make sure we supply energy in the most efficient way without jeopardizing energy supply, without jeopardizing our ability to use technology and collaboration to address climate change, which is serious. Saudi Arabia is in the front line. We're in one of the most heat-stressed, drought-stressed areas, so we're serious about climate action, and without jeopardizing giving the opportunity for developing countries and emerging countries fair access to the value of energy.
What about your transition, since you are the Minister of Planning? How dependent at this point is the economy on oil? Because the IMF did downgrade the outlook for Saudi Arabia based on the extension of the production cuts. And how are you tracking toward your goal of 2030?
So Vision 2030 is a long-term restructuring of the Saudi economy. It's not a short-term campaign. It's not a short-term program. And we look at our numbers, GDP numbers, as one of the indicators that tell us where we're going. We care about the non-oil economy. Non-oil activities today represent 52% of total real GDP for the first time. It's not everything, it's just a good sign to keep in mind. And non-oil growth has been steady. We expect to close 2024 at 3.9%, 2025 at 4.8% non-oil growth, and 2026 at 6.2%. And that's what we care about. The numbers that were revised down are the total GDP that includes oil GDP, that includes the function of oil production and our voluntary cuts. But what we really care about is transitioning from one economic structure that's reliant on resources to another economic structure that's reliant on productivity, human capital, and we're leveraging all our assets and capabilities to transition from one to another.
One more really quickie, because this was also brought up by the President yesterday. Big $600 billion commitment to investment in the United States from the Crown Prince. How about rounding it up to $1 trillion, as Trump suggested? Is that easy to do?
I'll tell you that there is a long-standing, strong partnership between the U.S. And the Kingdom that lasts so far 8 decades. We've worked very well on important work, global work, with all administrations, no matter which administration is in office. This number represents investments, procurement, public and private sector, and it's just a mirror reflection of the strong relationship. What we'll spend in the economy from the start of Vision 2030 till 2030 is 12 times that number.
Well, that might satisfy him. You know, you can't have a global discussion these days without talking about inflation, or that's been the case in the last few years, certainly. A managing director, have we put the inflation genie back in the bottle?
Well,
President Lagarde just sounded pretty optimistic.
So that is a very, very good question. Here is the bottle, here is the genie. The head of the genie is in the bottle. Most of the body of the genie is in the bottle.
Kind of getting stuck there, though.
But the legs are kind of hanging still out. We need to push it all the way down. It is remarkable how much progress the world has made. And I want to say something that we, in our worries about today and tomorrow, we not always reflect on. When we look into the past, over the last decades, every inflation episode would require interest rates to go up, and the response would be inflation would go down, but at the price of recession. This is the first time so far when inflation is being brought down, interest rates are still somewhat high, and yet we have admittedly below historic average, but still quite a positive growth. We have 3.3%. Historic average was around 3.8. So when we look at the next stage, if we succeed to bring inflation down and yet retain the economy functioning so people have jobs and, as Starman said, they get more confidence, that would be a very good outcome. And I want the audience to ask itself a question. How come this time it was different? What is different this time? What is different this time is twofold. First, after the global financial crisis, the world created mechanisms for economic policy coordination that didn't exist before. We have the G20, we have very active role of the Bank for International Settlement. Every month central bank governors get together. We have the IMF using our twice a year meetings for policy coordination. And what that translates into is more consistent coordination when necessary, but also divergence in policies when necessary. And the second thing that is different, we have Madame Lagarde in ECB.
Larry, I feel like I keep reading headlines. Larry Fink warns of inflation. We're not done with inflation. Larry's very worried about inflation. Why?
I'm not terribly worried. But
do you think the market's being too complacent about the inflation story?
no, I think the bond market is the best reflection of what's going on in the world. It is the barometer for every politician, for every central bank. It really informs us every day where the mood of the global economy. And that I believe the bond market is indicating that inflation may be higher than we think. The genie may be coming out of the bottle. And I look at this in so many different ways that if you just think about AI for a minute, in the United States right now, data centers represent about 50 gigawatts of power. And in the United States, we're estimating alone, data centers will represent and need 300 gigawatts of power in the next 5 years to meet the needs. And we're talking about, if you expand that throughout the world, this is my optimism about growth, but at the same time, we actually are going to have labor shortages, which is going to be driving up wages. I think we're going to see more persistent wages, and that may be a good outcome, but it's going to be an inflationary outcome. We're going to have material shortages with all this building out. And so I think we are somewhat complacent that inflation can hit us again. But I would also say, if you look at where the bond market was even a year and a half ago, when we were experiencing very elevated inflation, we had a very inverted yield curve. The short rates were higher than the long rates. What we are seeing now is the normalizing of the yield curve, but I also believe we're going to have a much more steeper yield curve. And that's a function of forward inflation expectations. And so one of my fears is, because of this complacency, and I have not even said the most ugly word that's facing economies, that's called the deficits and the debt of so many countries. When you think about the amount of capital that we're going to need to be financing all these amazing transformations, we have growing deficits worldwide. The cost of financing those deficits are going to go up. I think the yield curve is showing you that.
Yep. Yeah.
And so, I've said repeatedly here in Davos, I could see a scenario, I'm not calling for it, but I can't see a scenario where we have a 5.5% 10-year.
Yeah.
And really quickly, do you think the Fed's done cutting rates this year?
No, they still have room to cut. That will create a more steepening of the yield curve. So I think, the next few months of data and information will identify it. I would say to you the economy is very strong. It was very strong in the fourth quarter. And the evidence that we are hearing from different corporations that business is strong already in the first quarter. And so we have, and you see that in the labor statistics now. So they may pause for another period of time, and they may ease a little bit. I'm not worried about the short-term moves, but over the next year, if all this materializes, could they revert and go back up? Possibly.
Rate hikes.
A rate hike. I'm not calling for that, but all I'm saying is I see probabilities of that.
Yeah.
That's not my core prognostication.
I'm trying to get a headline here, Larry.
I'm trying to avoid one.
Very good. Just on the inflation story, not everybody is feeling inflation right now globally. I think we should mention in the global context that China has been seeing deflation, Mr. President. And I do wonder how you assess the Chinese economy right now and the outlook and the spillover effects globally.
Well, I think the Chinese will avoid an extreme downturn. They know what to do. They're measuring the pace of the measures they're taking to strengthen consumer spending, to get past the property market overhang. They have an extremely complex task of achieving all this in an economy that's not a fully market-based economy. But I think they'll get there. Growth might be somewhat slower than hoped, but I don't see a situation that leads us to a deflationary spiral. But more broadly, central banks and fiscal authorities have made mistakes in the last 15 years that set us on a somewhat higher plane of inflation for the medium term than we otherwise would be. But the fundamental advantage we've had for several years now has been two things. The entry of China and some other parts of the developing world into the global labor market and global trading system, and countries' willingness to be able to absorb their products. It's been a tremendous deflationary force, counter-inflationary force. But we're now past that. And we also have now an unprecedented situation of aging in the entire developed world, the West, Japan, increasingly China. The US is seeing stagnation in its population, even if it's not coming down. But you've got Africa that's coming up. You've got India that's still growing rapidly, still a rapidly growing population. So if you just think about that fundamental advantage we had for consumers all over the world in having an international trading system that allowed for emerging countries with growing populations and growing workforces and lower wages to be part of a global economy, how do we now replicate it in the next phase? When we have the added disadvantage of aging in the Western world and severe labor shortages that already exist. In Europe, for instance, there's already a very severe labor shortage, south to north. What do we do about Africa? What do we do about South Asia and some other parts of the developing world? How do we have, if you like, a global industrial policy so that we can benefit globally from higher productivity, but also a lower cost of goods for consumers around the world? I think that has to be an important challenge.
I think when it comes to the inflationary outlook, a lot will depend on trade policy with the U.S. and tariffs, right? I mean, is anybody on this stage a fan of tariffs? No. No one thinks it's a good idea. I wonder, Your Excellency, when it comes to the trade battle, the fact that President Trump has indicated he's going to use tariffs to get fairer terms on trade or for national security reasons or for negotiations. How does a country like Saudi Arabia fit in when the U.S. and China, for instance, have a deeper trade dispute or even a trade war? Do you find yourself in the middle?
I think we want to be in the middle, right? I think the kingdom's position is to have a strong partnership with all of its partners and friends, and that's something that is a value proposition of the kingdom that we want to grow. But on tariffs, I think depending on what objectives an economy has, it's been used as a tool, so long as it is objective-driven and time-bound. An economy has the right to build resilience or leverage or give space for the private sector to grow some competitive advantage, or to invest in adding new competitive advantages so that a local industry can start. So it's really about the details of tariffs, what it would look like, assessing its impact, and then figuring out how to deal with it. The important thing is to keep dialogue on the table and keep the orderly, respectful discussion going and maintaining it, even if it's been absent for a while or not where it should be, and continue working on it. The Kingdom values its partnership with all of its economies. Since Vision 2030, we've played an even larger role in more domains than oil and gas, diplomacy, and foreign aid and assistance, because we understand better through Vision 2030 what our economy needs and society needs for us to unlock its potential.
Both with U.S. and China.
U.S. and China and others.
President Lagarde, President Trump yesterday said that the EU does not treat the U.S. fairly on trade and that he has some big complaints. Is that true?
This is a true or false question, by the way.
Is it true that the EU has not been fair with the U.S.?
There is no way I can say yes or no, okay? What I believe is that he's looking very carefully at surplus versus deficit in the current account, and in the trade balance in particular, focusing on that. And I think that you have to look very carefully under the hood, as Kristalina was saying. You have to look at the goods exchanges, you have to look at the services exchanges, you have to look at the capital account. It cannot just be black and white. What is true is that there has to be negotiations, there has to be trade relationships that are organized in a framework that is giving confidence to the partners. It cannot be about, removing all the rules, ignoring the institutions. The world has, 190 plus countries that are members of the IMF, the World Bank, the WTO, 191. And it's about all of us operating together, as Tharman said earlier on. So, yes, you sit at the table, yes, you negotiate, yes, some countries are in a stronger position than others, but we all need each other. If there is one thing that the Europeans have learned over the course of time since the end of the Second World War, is that you cannot go alone. You have to work together. You have to respect each other's, and you have to understand each other's. For that, you sit at the table and you work, and I would not say enough about the strength of institutions. Any literature that you have about stability, about economic equilibrium, always reminds us that institutions have a huge value and that frameworks are here for players to know the rules of the game. And whether you look at trade, whether you look at financial regulations, I know that Basel III is in play, but there are values in having frameworks. There are values in all banks around the world learning and understanding and appreciating that having safeguards, having rules vis-à-vis each other's actually matters, and the best can win, but within a set of rules. That's how the world has to operate.
A lot of agreement here in this room. Managing Director Georgieva, you don't like tariffs. You've been warning against trade friction at the IMF. You are the institution that advocates multilateralism. So what do you do in this environment?
What we do is we look at the evidence. And here is what we find. It actually confirms that Saudi Arabia has the right strategy. We have been seeing over the last years increase in protectionist measures, tariffs, as well as industrial policy measures. And we have seen countries gravitating towards politically aligned countries in their trade practices. And what the evidence shows is that trade among politically aligned countries is higher than trade across politically aligned countries. But guess which category of countries is performing the best? The countries that are friends with everybody. So there is, in my view, what we are going to see over time is a reflection in trade and economic relations of a geopolitically changing world. More regional cooperation, more cooperation based on supply chains, more engagement that allows countries to achieve their objectives. And in our institution, we look into how we can support regions. How can we work more closely with ASEAN? How can we work more closely with the Gulf Cooperation Council? So we can provide the analytical and policy encouragement for that kind of practical cooperation. I mean, look, we were many thousand years ago just a handful of people on this planet. Today we are 8 billion. How did we get from there to here? Well, by collaborating and competing. And I think that there is no way we can wipe out collaboration from the future of humanity.
On that note, Mr. President, I thought there would be an applause for that. On that note, Mr. President, trade and industrial policy, as you just heard from the managing director, are very linked. You have some strong opinions here on industrial policy, I know.
Well, I think,
Please.
Whether it's tariffs or subsidies or the other forms of the new industrial policies that are now in the vogue, the fact is they're being driven largely by politics and geopolitics rather than by any powerful new understanding of economics, or any new evidence or any reappraisal of economics. And I think the jury is out as to whether this is going to succeed in lifting standards of living for ordinary people, for the middle class, and lifting economic performance for countries. It's happening by way of drift and tit-for-tat action. And we're in a very unstable situation now, quite frankly. So I think we have to take a step back. There is a case for industrial policy, and it starts from recognizing that innovation is the key driver for long-term growth. And innovation comes from capabilities. So the industrial policies that have succeeded in the past, and I think are still entirely relevant, are industrial policies that involve developing your own capabilities, R&D, skills, developing cluster synergies amongst firms, developing your own capabilities rather than constraining someone else's efforts to develop capabilities. It's about developing your own capabilities rather than constraining another country or the rest of the world. Because the difference between the two is that the first spurs innovation, and it spurs innovation through competition, and the second stifles innovation, and it stifles long-term growth. The second point, which is, may seem old-fashioned, but is still entirely relevant, and all the evidence still supports the proposition that global interdependence and some specialization that each country engages in is good for everyone. You don't have to be a purist, you don't have to know what Ricardo said, but the fact is, we all do better when we specialize at what we are good at and develop skill in what we are good at. And it's very hard to depart from that. The whole history of import substituting industrialization, which we saw in Latin America, we saw in parts of the developing world, and which we're now seeing in parts of the advanced world, has not been a pretty history. In fact, in general, it has led to massive inefficiency, which means costs for ordinary taxpayers, and big losses. Big losses. So develop our own capabilities, do it in areas where we have some advantage, some accumulated skills, some potential to succeed and develop scale, and complement each other in an interdependent world. There is a further very important case today for industrial policy, and that is we need to find ways of scaling up action on climate and the associated crises of biodiversity and a global water cycle that's out of sync, out of kilter. It requires the public sector. It requires state intervention to front-load investment, to be able to front-load even the demand for new innovations in green energy and all the other technologies that are going to get us to net zero. If you leave it to the markets, it's going to take too long, it's going to be too incremental, and in the meantime, the turning points kick in climate change, and we get into a much more dangerous world. From time to time, countries will feel they can put climate action on the back burner, but climate change is not on a back burner for you or for anyone else. The more we put it on the back, the more we put climate action on the back burner, the more we burn in future, the more the costs are going to be to address the situation, and the greater the inequality that we're going to face. So we've got to press ahead with addressing climate change, and it does require industrial policies involving public investment, involving subsidies, involving taxation policies, so that we build scale early and drive down the costs for ordinary consumers of new technologies. It's a very important contemporary reason why we need industrial policy.
So Larry mentioned the D word, debt and deficits, and it's a whole nother subject for another panel that we don't have time to get into, but I am curious, show of hands, since we're talking about the global economy, in the near term, how many of you have put sovereign debt levels, high sovereign debt levels, in your top 5 lists of risks for the global outlook? Yeah. Everybody. What about geopolitical tensions? Top 5?
Yeah.
No. Why not, Larry?
I mean, obviously it represents idiosyncratic risk, so we always have to put that into your forecast. Look at, if we're going to really grow the economy.
And that has been the panel of our colleague Sarah Eisen in Davos with a couple of key takeaways, really. So inflation is getting underway. Investors are keeping, authorities are keeping an eye on that because the IMF still saying they do not think that's fully under control. And the key takeaway from the BlackRock CEO saying that we could see 5.5% on the 10-year Treasury yield. For now, though, that's it from us. We'll hand you back to our colleagues stateside.
Good morning. Boeing shares are under pressure. The company warned that it likely lost $4 billion in the fourth quarter. President Trump says he knows interest rates better than the Fed, and he will demand they go lower. The comments set up a clash with Fed Chair Jay Powell ahead of next week's policy meeting. And Costco won't roll back its DEI policy. Shareholders siding with management to fend off an anti-DEI proposal brought by activists. It is Friday, January 24th, 2025, and Squawk Box begins right now.
Good morning and welcome to Squawk Box right here on CNBC. We are live from the NASDAQ market site in Times Square. I'm Becky Quick along with Mike Santoli and Robert Frank. Gentlemen, good morning.
Good morning.
Good to see you guys. Joe and Andrew are both off today. It's Friday, and we're going to take a look at what's been happening with the U.S. equity futures. At this hour, you see some modest declines. Dow futures off by about 70 points. NASDAQ down by 30. The S&P futures off by 9. But you were talking about quite a week that we have had. The S&P 500 at a record high once again. And just about every day, the Dow has climbed higher. Yesterday was up, I think, more than 400 points.
Yes.
At the end of the session.
Dow outperforming yesterday.
So S&P at a new high. The Dow is within 1 or 1.5% maybe of a new all-time high.
Same with the NASDAQ.
And the NASDAQ too.
Yeah, I was lucky enough to be on the air with you Monday to
It was
cover the
fantastic.
inauguration.
We really appreciate
and
it.
today is Friday, and it feels like this week, it feels like that was a month ago in terms of headlines. I mean, I'm going to have to start drinking coffee to get through 4 years of this because it was an incredible week.
Yeah.
Even within the day, there would be like 5 headlines that affect markets, that affect currencies, that affect the outlook for certain companies. So,
and you can't turn away during the market day. I mean, that's what is amazing to me. This is not where you set your agenda. You know what's coming. You kind of go for it. Changes come up pretty fast.
What's interesting to me is that reveals what the market either wants or fears or kind of is able to shrug off. And you know, the S&P is up 2% this week. It's up 4% year to date. We had 57 record highs last year, so we got our first one of this year. I think it's kept on trend even while it's seizing on the individual little policy hints and priorities that are being revealed. I think that the binary is big across the board, tariffs bad. Every day we go without that being threatened or coming into reality is okay.
Well, also, and yesterday Trump basically said, I don't want to put big, heavy tariffs, at least on China. On China for those aspects. He'd rather not do it, basically admitting it's a negotiation to see where you can get better, fairer trade across places.
and to your point, Mike, what the market has shrugged off, I think when we're looking at Trump 2.0, the market has matured in its reaction to what he says. And so that comment yesterday about interest rates and the Federal Reserve, I think in the first time around probably would have gotten more attention in the bond market, certainly in the stock market.
Yeah.
And yesterday it was I was a little bit pleasantly surprised at how the markets just saw that and say, yeah, that's him, and we really probably won't see any action. Or
that it was so thoroughly previewed that we sort of knew that is going to be his stance. That's going to be the pressure point. The 2-year note yield did immediately go down like a couple of basis points and then stayed there for the rest of the day.
Yeah.
But that's just marginal little around the edges types moves.
It's been fascinating to watch. And I know we talked about it earlier this week, just the Wall Street Journal story that came out that said he's inheriting the most expensive stock market that any president has ever inherited, if you're looking at some of the metrics on how you measure these things. You would think it would be harder for the market to rise under those conditions, but that has not been the case. And I wonder if that's the counterintuitive.
Yeah, not yet. I mean, George W. Bush pretty much inherited a similarly expensive market, but that one had already started to fall, and we were kind of at risk in the year 2000. But I think that what that tells you is most of why the market is where it is because of all the other stuff that's been going on.
Like
right?
earnings. It's been very strong.
AI, and the fact that we seem to have come into 2025 at a 3% real GDP growth pace, if you believe the Atlanta Fed. So in other words, the market is saying, we don't really need a whole lot of help. We can probably use it, and we'll be glad to seize upon it if you want to give us fewer regulations and a little bit less of a tax burden, but it's not as if there's something absolutely broken that needs to be fixed.
Mike and I were having a slightly market nerdy conversation earlier about the equity.
You guys? No way.
The equity risk. I
didn't even initiate it.
The equity risk premium, which the FT has an interesting article. Basically, it's the compensation you get as a stock investor versus the bond market is either low or even negative, and it hasn't been there in over 20 years. And so.
It's basically the earnings yield of the S&P, which is the opposite of the price earnings ratio, compared to the 10-year Treasury yield.
And the implication is that you're not getting paid right now for the risk of owning stocks. Therefore, they're very expensive. And I asked Mike, there's a lot of debate about whether this is an interesting or indicative measure or whether we should discount it.
Yeah, I think it mostly tells us what the interest rate environment is. In other words, I don't know that it gives you that much more information except
and that
to say,
stocks are
we
still
know
expensive.
that the S&P is at 21, 22 times earnings.
Right.
We know the 10 years at 4.6 or thereabouts. Yeah. And so there's no magic precise relationship where they should be, so to speak. For much of the 80s and 90s, it was negative because rates were higher.
Okay.
In the 2000s, it looked like you were getting paid a lot to own stocks because rates were lower. Right. And so I think there are a lot of critiques of this as an idea that it tells you where the market should be.
It just goes back to Buffett's saying, Warren Buffett saying that interest rates act as gravity on stock prices.
Yes,
You know,
there's no doubt. And if it's a restraint on the economy, if it does give you a little bit more of compensation to own safer bonds versus take the risk in stocks, maybe that makes decisions at the margin. But the reason equity valuations are high is because people are excited about growth prospects.
Yeah, everyone says these stocks are really expensive and I want more of them.
Right.
So that's not going to change.
Yeah.
So we mentioned that President Trump said yesterday he would like to see the rest of the globe take up what the U.S. Federal Reserve has done and lower interest rates. Well, this morning the Bank of Japan said no thanks. They raised interest rates by 1/4 point overnight, bringing its policy rate to the highest level they've seen since 2008. The bank is seeking to normalize the country's monetary policy amid signs of sustained inflation and rising wages. Following that decision, the yen strengthened slightly against the dollar, but we all know the dollar has been so strong, it's risen so rapidly in the last quarter, and that's been an issue for some of these big multinational companies as they've been reporting earnings. They say it's a big headwind. They're trying to find ways operating to work their way around it.
Yeah, I do think a lot of the earnings guidance and conference calls is probably going to have a lot of FX talk. How is this going to change our guides? Historically, the market doesn't usually get too alarmed about these things, but it's definitely...
Well, we had the CEO of Procter & Gamble, John Mueller, was on, because Jamie Dimon had been on. I asked him about the strong dollar. He said, oh, yeah, it's not a big deal. John Mueller said, yeah, easy for Jamie to say.
Right.
If you're not somebody who's having to deal with this.
Goods
right. You have so much of your earnings that are overseas.
Yeah.
Bringing those earnings back, they're less valuable on our balance sheet.
JP Morgan sells dollars. It doesn't sell things priced in dollars.
Right.
So it's a little bit different, yeah. We are watching crypto prices this morning as well. President Trump signed a sweeping executive order yesterday aimed at reshaping America's digital asset strategy. It paves the way for the potential development of a crypto stockpile by the government. The order provides few details, though. On the campaign trail, Trump said he would make it his policy to stockpile crypto that was lawfully seized by the federal government instead of auctioning it off. I think that's where this discussion is happening. In other words, the stockpile would just be a residual of, asset seizures.
We're just going to hold on to it instead of auctioning it because we think it's going to be worth more down the road.
Right. Yeah, which is, about $20 billion that they've confiscated right now in terms of market value. But what's ironic about this is that one of the base cases for crypto was always, look, we're not part of the government. Yeah. And now the excitement is we might be part of the government. They might have a stockpile. So
it's absolutely been a massive shift.
Yeah.
I mean, the purists for crypto were like, ETFs are bad. You should just own the actual thing. And I do think it is interesting, though, because if it's not the government going out and building a reserve, it shouldn't matter for Bitcoin price.
Right.
Really.
Right. I was just checking the price of dollar Trump, the Trump token. So that's now got a market cap of around $7 billion. So it's fallen by half since Becky and you and I were talking about it on Monday. Yeah. So that's a market cap. There's only 200 million of the 1 billion supply out there now. So the market cap of that 200 million is 7 billion. The Melania coin is down to $500 million. Still not bad for a coin that was just launched on Sunday. So
there's no right or wrong price for any of these things. That's the thing.
All right, another political news. President Trump speaking virtually to the World Economic Forum in Davos yesterday. Among the highlights, Trump told companies, if you don't make your product in America, you're going to have to pay a tariff on rates. On rates, he said, demand that the Federal Reserve drop interest rates immediately, and he said they should be dropping all over the world. He later told reporters that he knows interest rates much better than, quote, the one who's primarily in charge of making that decision, apparently referring to Fed Chair Jay Powell. Trump says if he disagrees with the central bank, he will, quote, let it be known, which he certainly did yesterday. At Davos,
she does always, I think.
Yes, reminds us. At Davos, Trump yesterday also said he would ask Saudi Arabia and OPEC to lower the price of oil. Crude right now, what is crude doing? Around 75, so down a little bit, but not much movement there. Trump also accusing several banks of refusing service to conservatives. We're going to dig into those comments a lot later in the hour.